Hey everyone, welcome back to the Week in Charts. I'm your host, Charlie Bilello, and today, as always, we're going to run through the most important charts and themes in markets and investing. So let's dig right in. I want to start today with inflation and how it's taking its toll on the American consumer. So we've talked about the important factors that are going on here. So you have 22 consecutive months where the rate of inflation is outpacing the rate of wage growth. That's a long period of time, and that's leaving a gap in terms of what people can afford. And so, in order to maintain their purchases and their purchasing power, people have had to adjust, and they've adjusted in two ways. Number one, they're saving less. So, if you look at savings rates, they've gone way down. Number two, they're borrowing more. And this is what we're showing here. A 15.2% increase in credit card balances over the past year. That's the largest year over increase we've seen since 2001. And in 2001, of course, we had a recession. And what people are worried about today is perhaps we're going to be entering another recession. And why this increase in credit card balances is really becoming more problematic is this chart right here. So we have the average interest rate on credit cards in the US up to over 19%. That's the highest we've seen on record with data going back to 1995. So, with rising interest rates in terms of Fed policy, that's lifted interest rates in terms of credit cards. And now we're seeing people having a much more difficult time, as we'll show in a bit, paying that credit card debt back. So, while some people pay off their balance for credit cards, and that's something that we should all try to do, a lot of people don't. So more than half of Americans don't pay that balance off every month, and now that debt is growing and it's becoming more difficult to pay off with these higher interest rates. And of course, the expectation is, unfortunately, this is going to continue in terms of the average interest rate because the Fed is likely to hike at least a few more times. That's the current expectations from the market. So, if we talk about debt, which age group has been really hit hardest by increasing debt and the rising inflation picture? It's really been the millennials, if we look at the data. So, this is a study that came out by the Federal Reserve Bank of New York. Ages 30 to 39 saw by far the biggest increase in debt over the past few years. If we dig in and look at credit card balances, this is pretty remarkable. 26% increase for millennials over the past 3 years. And why that's really interesting is we've actually seen older generations, the baby boomers and silent generation, actually reduce their credit card balances over the past few years. And Gen X is just up a little bit. So millennials having a much more difficult time, and now they're having a more difficult time, it seems, uh, paying that debt off. There is a rising delinquency rate across the board for all generations, but millennials clearly at the top of the list, well above pre-pandemic levels. So millennials getting hit harder thus far by inflation and rising debt, rising interest rates. So speaking of rising interest rates, let's talk about the mortgage market. The housing market, of course, is in a recession, has been now for some time, and we've seen an absolute collapse in mortgage applications. So this chart here shows purchase and refinancing indexes for mortgages. And if we look at that purchase in the blue here, that's at its lowest level now since 1995. So incredible collapse in terms of people taking out new mortgages to buy homes. And the reason for that, pretty simple, they can't afford that home. So if you can't afford the home, you're not going to get a mortgage for it. And then we've seen a collapse in terms of the number of mortgages out there. This chart tells that story. We saw just an absolutely unprecedented spike in the mortgage rate in 2022, went to over 7%. It's come down a little bit since then, but at 6.5%, still extremely high, and still more than double what we were looking at in 2021. And so, what does that mean for the average person that's looking to buy a home? Well, you can afford now a much lower price home. Redfin had an interesting data point on this. In 2021, when you had mortgage rates at 3%, you could have afforded a $518,000 home with a $2,500 monthly budget. Today, that same budget will buy you only a $385,000 home. So very different picture here. If you look at these different lines here, this is 2023 in orange, well above what we're looking at a year ago in terms of the average mortgage payment needed to buy the median priced home in the US. Significant increase, of course, over 2021 levels and 2020 levels. So, very simply, prices went up a lot. You had mortgage rates more than double, and that's leading to an unaffordable housing market. And really, there's only two ways affordability can improve. Number one, prices come down. Number two, mortgage rates come down. Mortgage rates have come down a little bit, but certainly not enough. So that leaves prices. And we're already starting to see that. So we got new data in terms of new homes sold. The average price now is down 16% off of its peak from last year. And during the last housing bubble, prices went down over 25% nationally. So certainly there could be a further reduction here. And the big driver of that, again, is going to be affordability. So is 16% enough to improve affordability so that demand will come back into the housing market? It doesn't seem to be. And I put out a data point really illustrating that. This is just a stunning statistic here. 3 years ago, a 30-year mortgage rate was at 3.45%, and the average new home price in the US, 384,000. Fast forward to today, you have a 6.5% mortgage rate, so more than 3% higher than 3 years ago. And at the same time, you have that average new home price up to 474,000. So, what's the result of that? What's that math mean for someone coming into the market today? Well, you need $18,000 more in terms of a down payment to afford that average home price, assuming 20% down. And you need 75% more in terms of your monthly payment. So monthly payments gone from $1370 a month to for the average new home price up to $2396. And that's simply, that math doesn't work for people because, of course, people's incomes have not increased 75% over the past 3 years. So you're not going to be able to get a mortgage. They're not going to give it to you if you can't afford it. So the affordability equation has to only improve with prices coming down because we're just not going to see the people's incomes go up enough to change that picture. And while mortgage rates could come down, as long as they're sitting there at 6-7%, even if they were to come down to, let's say, 5.5%, you still have this affordability equation weighing on the market. So existing home sales telling the same story as new home sales. So what we're seeing here so far, 13% decline from the peak last year. That's the biggest decline we've seen over this period of time. You have to go back to 2010, 2011. So pretty sizable decline already for existing homes. But if we compare it again to the last housing bubble, we saw a much bigger decline. It took a number of years to get there, but we eventually saw a 33% decline in existing home prices from the peak in July 2006 to the bottom in January 2012. And if we look at today, let's say we go back to the peak last year and we take off 33% off of that. Interestingly, that only brings you back to early 2020 levels. So even a 33% reduction is only bringing you back to early 2020 levels. And the reason for that is because we had just an enormous mania that drove home prices up 40% in a 2-year period. And therefore, even a 33% decline is only bringing you back a few years in terms of pricing. And so a different situation than we saw during the last housing bubble, with prices really more unaffordable today than back then. And if we look at what this has done to demand, it's been an absolute collapse, as you might expect. So demand for existing homes, lowest level since 2010 in terms of the number of home sales, 12 straight monthly declines, 37% year over year the decline in the number of new existing home sales, largest on record. So across the board, we're seeing the affordability picture play out in terms of a collapse. So in demand. And so what we've seen is sellers have not been quick enough to reduce their prices. So People perhaps waiting, pulling their houses off the market, thinking the prices will come back, as they often do, and as they did after the last housing bubble. But eventually, if you need to sell your home, which people do eventually, if people need to move for any number of reasons, a homes are still getting sold, and when they do, the clearing price is increasingly at a lower level. So, what segment of the market is experiencing declines in terms of prices, in terms of activity? It's really across the board. This is showing activity, sales activity from a year ago, and everything from low end to high end is seeing a reduction. Actually, the high end is seeing the biggest reduction in sales. So, homes that cost $1 million or more, activity there down 41% from a year ago period. So, big declines. Housing market clearly in recession, and the biggest driver of that is the rise in interest rates. And so, rising interest rate, bad for the housing market. Who is it good for? It's good for the savers, good for people buying treasury bonds, treasury bills, because these are the highest yields that we've seen since 2007, certainly on the short end, where you can get over 5% now in 6 month and 1 year treasury bills. But even on the longer end, more than double the yields that we saw at the end of 2021. So, a big shift in just a short period of time in terms of the yield you can get on treasury bonds. So, let's look at the 2 year yield, and fascinating picture here. Highest since July 2007 at 4.78%. But what's really interesting here is how wrong market participants were last year and the year before. So if we look at last year, 2 year treasury yields at 1.5%. So market participants essentially anticipating Fed rate hikes of up to, let's say, 1.5% over the next 2 years. We blew past that obviously last year, and the Fed is still hiking rates. But if we go back to 2 years ago, you have a Fed funds rate at zero, of course, the 2 year treasury yield close to zero, meaning even then market participants were not anticipating any hikes for the Fed over the next 2 years. So just a stunning difference, proving once again the market is definitely not always right. And perhaps they're wrong again today. So the market is expecting, let's say, treasury yields 2 years from now, 4.8%. So perhaps the Fed hikes and the Fed cuts, which is what the market's currently expecting. But the market could be very wrong in either direction. So just be careful thinking that just because the market is showing one thing, that it's right. They've gotten it wrong time and time again. And of course, over here, probably one of the most prominent examples we'll have in history of the market simply getting it wrong, thinking the Fed would not react to inflation in a meaningful way. And of course, they have, and they continue to be focused on bringing down that rate of inflation. So if we look at treasury yields, I like to put out this chart since 1990. It really shows a few different regimes. First, we had kind of what was for a long time a normal regime, where you had a reasonable yield that you could expect on your money in terms of buying treasury bills or treasury bonds. That all changed after the financial crisis here. Fed cuts rates in December 2008 all the way down to 0%, holds them there for 7 years until December 2015, finally hikes, but is very slow in hiking interest rates. Stops hiking in December 2018 and does an about face cutting rates in 2019, and then goes back to zero during the COVID recession and pandemic. So since then, we've seen what's really just been a normalization in terms of interest rate policy. It's been more. It's felt so extreme because of how quickly it's happened, but we're simply going back to where we were, let's say, in 2006, 2007, to a more normal interest rate environment thus far, right? So it feels so shocking because we had this just long period of time of just ultra easy monetary policy. So that shift to a normal interest rate policy seems incredibly shocking for most people. And importantly here, If we look at this yield curve story, it's still telling a story, still forecasting future economic weakness. So this is really lingering over the markets, this yield curve. And during that 20% run up for the S&P, you had a lot more people dismissing it, saying the yield curve is wrong. This time is different. But it's still out there, this signal, and suggesting we're likely to see, as we often do with Fed policy, a lag where these rising interest rates are going to start to hit the economy more broadly than just the housing market and certain areas like used cars. And the expectation from the market seems to be that we're going to see economic weakness relatively soon. So if we look at the 60/40 portfolio in the US, talk about drawdowns, we had over a decade of just simply smooth sailing pretty much for this portfolio. Time and again, people would say, is the 60/40 portfolio dead? And time again, it would continue to march on. Had three enormously positive years in 2019, 20, 2021. And you had pretty much any correction was very short lived. So even during that 2020 pullback, very quickly, the 60/40 portfolio back to new highs. And that was really a trend that we saw throughout the 2000s and 2010s and into 2021 markets hitting new all-time highs a couple of times a year, and it's up a couple times a week. And so just incredible number of new all-time highs during this period of time. And really, there was never a period of that lasted this long without your portfolio going back to new highs. But clearly now we're in a different regime. 14 months now where that 60/40 portfolio has not hit a new high. We're still 14% off the prior peak levels. So unless we see just a sharp vertical move higher, it's likely to be at least a few more months before we get there. But if we're looking at that 60/40 portfolio, this is not something new. It just hasn't happened in a long time. So during the financial crisis and recession, this portfolio went 37 months without hitting a new high. After the dot-com bubble, even longer, 43 months. So this is a risk that's always present in markets. We just haven't seen it in some time. And it's really the reason why you earn a higher return on investments than risky investments than safer investments. It's that risk of drawdown, that risk of volatility, that risk where it's going to take years perhaps to hit a new all-time high. And that's what we're seeing today. So risk is really returned. It's evident. And without that risk, there wouldn't be ultimately higher reward. So the question people are asking is how much longer is it going to be a repeat of these periods of time? No one has the answer to that. So all we know is that every time in the past when 60/40 portfolio has had a drawdown, it's eventually come back. I don't think that this time is different in that sense. The question is just how long will it take? And on the bond side, if we go back to that treasury yield picture, it's going to be much better from here for bond investors. Surely, if interest rates continue to go up, let's say interest rates go to 6 or 7%, that's going to cause a lot more pain for the bond market. But if we're looking out longer term, let's say the next 5 to 7 years, there's going to be a much better return environment for bonds simply because interest rates are much higher. On the stock side, much more difficult to predict because it all depends on valuations and what people are willing to pay for a given level of earnings. And that, as I've always said, is impossible to predict. So for the markets, they are still in this kind of range where they're struggling to push much higher in the short run because there's a lot of factors that are weighing on investors, and we'll talk about that in a little bit. So after a really strong start to the year, S&P having its first pullback, 5% pullback so far, so not huge. But as you can see here, pretty much every year has at least a 5% pullback. And on average, since 1928, we've actually seen 16% pullback during intra-year on average since 1928. And the interesting thing is S&P 500 over this period of time has returned almost 10% annualized. So risk in markets is always there. It's a feature, not a bug. and the magnitude will vary from year to year, but you're always going to have a drawdown. And of course, last year we had the worst year for the S&P 500 since 2008. But many years you can see these drawdowns occur, and the market is still positive. So risk is always present. If you're a long-term investor, you need to be able to stomach that and embrace that risk, and eventually you're going to be rewarded for it. But what I found fascinating is this 5% pullback really shifted the sentiment picture. So on the last video, I talked about how sentiment was starting to get more bullish. We had that 20% rally off of the October lows, and that was really getting people more optimistic. Naturally, people are starting to talk about no landing, economy's improving, and looking past earnings and saying things are going to improve. But very quickly, with that 5% pullback, the bears are back. So bears now outnumber bulls again in that AAII sentiment poll, and active managers have reduced their exposure again. So it didn't take much for fear to come back into the market. And speaking of fear, if we look at the VIX average call volume, so people betting that volatility is going to increase, average call volume in February was the highest we've seen since March 2020. So certainly still fear in the air. What are people afraid of? Well, take your pick. There's so many reasons, and all of these reasons were around in 2022, and in many respects, they're still here today. So inflation, still a concern, still a worry. People saying it's not coming down fast enough. We had that core PCE number come in above expectations. That's leading to fears the Fed is going to hike more and leave rates higher for longer. We still have a Fed funds rate below that core PCE rate. And as we've talked about, every time the Fed has been faced with high inflation, they've hiked above that rate. So certainly more hikes to come. So inflation still a concern. You have Fed tightening. Again, 3 rate hikes expected currently. Balance sheet continued to come down, and still nowhere near what we saw even during the last period of tightening for the Fed's balance sheet. So much more to go here. Then you have the economy. Recession fears are back on the table after that 5% pullback. If we look at retail sales, we talked about in the last video, overall retail sales declining on a real basis year over year. And this is just looking at e-commerce retail sales on a real basis. So adjusted for inflation, they actually declined again in the fourth quarter last year. So recessionary fears are there. It's not so far what we saw during the financial crisis, but definitely a difference, definitely a market slowdown if we adjust for inflation. Then you have earnings, of course, declining 3 consecutive quarters, worries that that's going to continue. And you have profit margins, and this is an important one. Profit margins were a big tailwind for the market, hitting record highs in 2021. Now we've seen a trend of the opposite scenario going on, 6 consecutive quarters where profit margins are declining. And what's underpinning that? Well, simply costs are rising, and companies are having a harder time passing on those higher costs to the end consumer. Lastly, you still have the tail event of the Russia-Ukraine war, certainly costing more and more and seems to be increasing every day. And you have, of course, the concern, the fear that the U.S. is going to get further involved in the war, and what that would mean. And hopefully that's avoided. Hopefully there's a resolution there, but that's still a risk weighing on the markets. Let's talk about WeWork. This is an interesting one. WeWork's obviously fascinating company, but the losses in WeWork just really piling on here. If we look at WeWork since the start of 2016, $15.7 billion in total losses. They lost another $2 billion last year. Smaller loss than the previous few years, but still $2 billion is not a small amount. And investors have been reacting the way you probably would expect, which is punishing the company in terms of its stock price. Its current market cap's down under $1 billion, and its peak market cap was actually $47 billion in the private markets in 2019. So what an incredible run higher, and now lower, and the losses continue to mount. WeWork went public via that SPAC back in October 2021, so not far off the peak of of the mania, and there was a lot of excitement. A lot of people actually saying you should buy WeWork, and very quickly it's moved in the opposite direction. Certainly, along with other companies in the space, and hit a low market cap low late last year of 750 million. So WeWork, fascinating story. We could talk about it all day, but to me, I keep coming back to this in terms of expectations and how wrong they can be. And really, the evidence of a mania was there anywhere you looked. So this is a company that had been losing billions of dollars already at this point, and this is what people were telling the founder of WeWork, who actually cashed out and I think walked away with over $1 billion. They were these big investment banks were telling him that they could IPO the company for 60 billion, 90 billion, or over 100 billion back in 2019. And here we are, fast forward a few years later, the company is valued at less than a billion. So just keep that in mind. How how unbelievable expectations can be during a mania. And while there were some people that were skeptical of this, or of course many people listening and thinking we was worth this amount of money back then. And so, uh, speaking of losses, we have another company, Carvana, and they've really been forced to shift their priorities, which they said in their latest shareholder letter. If we look at the losses from last year, uh, they'd always lost money. So back data going back to 2014 every year. But in 2022 is really a record year in terms of losses, 1.59 billion for the company. And they outlined what happened, and simply, like many companies, they were positioned for growth. So they were not expecting anything other than just growth, up and up and up. And revenues did grow in 2022, but they grew much slower, and costs were obviously much higher than revenues, leading to that big decline. So they were positioned for another huge record year in terms of growth, and what they got instead was a slowdown. They're blaming a number of different things, but really talking about rising interest rates here, and market sentiment is shifting their priorities away from growth and towards profitability. So all of a sudden, uh, Carvana, like many other companies, being forced to think about profitability. Back during the mania in 2020 and 2021, nobody cared about profitability. All they cared about was rising revenues, and Carvana's revenues were increasing very rapidly during that period of time. Hit a peak market cap of over $30 billion here in 2021, and now at $1 billion, went as low as $394 million. So a lot can change in a short period of time. People talking, of course, now today about Carvana perhaps going bankrupt, other things. And back here, of course, all people were thinking about was that top line revenue growth number. And today, it's the bottom line that really matters. And so, what is Carvana doing? They're cutting costs. They're talking about cutting costs $1 billion. Will that be enough to prevent bankruptcy? Remains to be seen, but I guess it's a start. Even at that level, it seems like there's going to be more losses, at least in the near term. So, Carvana, interesting case study. Another one in terms of the mania on the way up, and now the aftermath on the way down. And I want to end, like I always do, with something positive. Talk about the breadbasket of the world. That's a region looking at Russia and Ukraine. We talked about this a year ago when the war started. Russia's largest exporter of wheat, and Ukraine fifth largest. So big concern back then. Really valid concern was going to be if supply was constrained, what is that going to do to the price of wheat? And what it did initially is the price of wheat skyrocketed in terms of looking at wheat futures, and really it stayed elevated for a number of months until there was an agreement last July to allow for the export of wheat, not only in Russia but in Ukraine, and to keep that supply on the global market. And so what has happened And fortuitously, you actually had a very good wheat crop, I think a record wheat crop out of Russia last year. That's helped with supply, but just the ability to sell that wheat in Russia and Ukraine to the global market has helped alleviate those fears. Prices come down, and hopefully this Black Sea Grain Initiative, which was the deal they made to allow for the wheat to be sold, it will be renewed when it's set to expire on March 18th. So hopefully that will be renewed. And this trend will continue, and prices will either continue to come down, at least not spike higher. And if we look at commodities in general, it's pretty remarkable. Certainly, surprise to me that a year after the war started, if we look at the Bloomberg Commodity Index, which is a number of commodities in there, is actually lower than it was a year ago. So we had that, of course, spike pretty much every commodity a year ago. Obviously, crude oil, gas prices hitting record highs, and all the agricultural commodities. And now we're seeing prices actually down on a year over year basis. So great thing to see. Hopefully it stays there. Hopefully it continues. I suspect this is going to really drive down the inflation numbers in the months to come. And so hopefully this will stay. This will stay this way and continue to trend in this direction. So let's end it right there. Have a great week, everyone. Thanks for joining. If you like the content, subscribe to the channel, and I'll see you next time. Thanks.